For 60 years, markets have tried to decode Warren Buffett. They studied his letters. They modeled his ratios. They imitated his patience. But they misunderstood the architecture. Because Buffett has never communicated primarily through speeches. He communicates through positioning. And what he has just done at age 95 is not symbolic. It is structural. This is not the story of a retirement. It is the story of a transfer of weight. On January 1, 2026, Buffett stepped down as CEO of Berkshire Hathaway. Headlines framed it as generational succession, a clean handoff, a ceremonial close to a legendary career. But beneath the visible narrative lies something heavier. Berkshire Hathaway is now holding approximately $381.7 billion in cash, the largest cash reserve in corporate history. Not during the 2008 collapse. Not during the COVID panic. Now, at record market highs. That timing matters. For 12 consecutive quarters, Berkshire has sold more equities than it has purchased. Positions once considered permanent. Apple, Bank of America reduced. Share buybacks halted. Liquidity elevated. Risk quietly withdrawn. Markets celebrate artificial intelligence breakthroughs. Indexes float upward on optimism. Valuations stretch into historic territory. And the most disciplined allocator of capital in modern history is building cash. Not cautiously, deliberately. This is not a headline event. It is a buried signal. Because cash in Buffett's framework is not laziness. It is stored optionality. It is dry powder. It is insulation against gravity. When a capital allocator of this scale steps back from risk while the crowd leans forward, the divergence is not emotional. It is mathematical. The Shiller-Cape ratio sits near extremes historically associated with compressed long-term returns. Corporate debt remains elevated. Government deficits expand without structural correction. Liquidity cycles are increasingly dependent on central bank credibility rather than organic productivity. And yet optimism dominates the surface narrative. The theater continues. Media focuses on AI dominance. Political cycles dominate airtime. Geopolitical tensions provide spectacle. Military budgets expand. Election rhetoric intensifies. But capital flows tell a different story. Behind the scenes, the largest insurance-backed investment conglomerate on Earth is not reaching for growth. It is stepping away from it. This is not about predicting a crash. Buffett does not forecast headlines. He studies imbalance. He waits for mispricing. He protects against asymmetry. The question is not whether markets will fall tomorrow. The question is more dangerous. What conditions must exist for Buffett to prefer $381 billion in near-zero yield liquidity over equity ownership at scale? Because cash, in real terms, erodes under inflation. Cash loses purchasing power over time. Cash is typically a temporary bridge, not a destination, unless the alternative carries greater risk. History shows a pattern. In 1999, he resisted the dot-com euphoria and was criticized for missing the rally. In 2007, he accumulated liquidity before deploying it into crisis. In 2020, he moved selectively, but not recklessly. His discipline has never been about chasing momentum. It has been about surviving structural stress. The architecture of markets today appears strong from the exterior. But structural stress rarely announces itself loudly. It builds in load-bearing beams. Valuations expand faster than earnings. Debt expands faster than productivity. Government borrowing normalizes emergency measures. Passive flows dominate price discovery. Liquidity becomes policy-dependent rather than earnings-dependent. These are not dramatic shifts. They are slow ones. And slow shifts are more dangerous because they alter the foundation while the facade remains polished. When Buffett reduces exposure at scale, he is not expressing fear. He is expressing asymmetry awareness. He understands cycles not as emotional waves, but as credit expansions followed by reversion. He understands that liquidity is abundant until it isn't. He understands that when markets are priced for perfection, even stability can disappoint. Most investors focus on return. Buffett focuses on survival. That distinction is not philosophical. It is operational. If Berkshire were aggressively buying at these valuations, it would signal confidence in sustained earnings expansion, manageable debt loads, stable policy frameworks, and reliable liquidity channels. Instead, we see restraint, patience at historic scale, a fortress balance sheet built not for expansion, but for endurance. And when endurance becomes the priority, something in the system is being weighed differently. This investigation is not about predicting catastrophe. It is about examining divergence. Surface narrative versus capital behavior. Public optimism versus private positioning. What no one is saying openly is often visible in what institutions are doing quietly. The ignored signal is not in headlines. It is in allocation. And allocation, unlike commentary, carries consequence. If this were merely a retirement transition, the positioning would not matter. But this is the final architecture Buffett leaves behind. A structure built not on enthusiasm, but on insulation. The coming years will not be defined by daily volatility. They will be defined by structural gravity. In this analysis, we will examine the data beneath the narrative. We will separate theater from capital flow. We will evaluate whether this pivot represents caution or preparation. Because when the most experienced allocator of risk in modern history builds the largest cash reserve ever recorded, it is rarely accidental, and the data suggests something heavier than sentiment is shifting. The question is not whether markets feel stable today. The question is whether stability is being subsidized. What follows is not prediction. It is examination. And the signals, once assembled, form a pattern that is difficult to dismiss. A quiet move, behind the scenes, an ignored signal buried beneath optimism. Let us begin with the data. What the data says begin with the numbers. Because numbers do not perform theater. As of late 2025, Berkshire Hathaway holds approximately $381.7 billion in cash and short-term U.S. Treasury securities. This is not idle liquidity in bank accounts. It is primarily concentrated in short-duration Treasuries instruments chosen for safety, flexibility, and immediate deployability. This figure now represents a historically unprecedented percentage of Berkshire's total assets. At the same time, Berkshire has been a net seller of equities for 12 consecutive quarters. Major reductions occurred in Apple, historically one of Berkshire's largest and most profitable holdings. Positions in financial institutions, including Bank of America, have been trimmed. Share buybacks, once aggressively used when management viewed Berkshire stock as undervalued, have slowed significantly. Acquisition activity has been minimal relative to available capital. 12 consecutive quarters. That is not rebalancing. That is policy. Markets during this period have not been collapsing. They have been climbing. Major indices reached record highs driven by AI-related enthusiasm and expanding multiples. Earnings growth has been uneven. Valuations, however, have expanded consistently. The Shiller-Cape ratio has hovered near levels historically associated with low forward 10-year real returns. Not collapse compression. Corporate debt remains elevated relative to GDP. U.S. federal deficits continue expanding in non-recessionary conditions. Interest rates, after rapid tightening cycles, remain structurally higher than the ultra-low regime that defined the previous decade. Liquidity is present but conditional. In this environment, Berkshire is not expanding exposure. It is reducing it. This matters because Berkshire is not a hedge fund reacting to quarterly flows. It is an insurance-backed capital allocator built for long-duration positioning. Its float, insurance premiums held before claims are paid, provide stable capital that allows long-term investment. Historically, when Buffett accumulated large cash positions, they preceded major deployment periods. 2008 to 2009, liquidity deployed into distressed financial institutions. Early 2010s, selective acquisitions during muted valuations. COVID period, cautious but opportunistic positioning. Today, deployment is absent. The signal is not fear. It is restraint amid valuation expansion. And restraint at scale is intentional. Why this behavior is abnormal. Cash accumulation during crisis is normal. Cash accumulation during euphoria is not. equity markets currently reflect optimism tied to artificial intelligence productivity gains, reshoring narratives, fiscal stimulus effects, and assumed soft landings in monetary policy. Price-to-earnings ratios in large-cap technology sectors have expanded faster than aggregate earnings growth. Passive investment flows continue to dominate price discovery mechanisms. Retail participation has increased through low-cost platforms. In such an environment, capital allocators typically lean into strength, especially when earnings remain positive and liquidity is accessible. Buffett is not. This divergence is abnormal for three reasons. First, Berkshire's mandate historically prioritizes owning productive assets over holding idle cash. Buffett has often emphasized that cash is a poor long-term asset relative to equities. For him to hold nearly $400 billion suggests he views current alternatives as less attractive than short-duration government paper. Second, the magnitude exceeds precautionary norms. Even accounting for insurance requirements and acquisition flexibility, this level of liquidity surpasses prior defensive positioning outside crisis windows. Third, the duration matters. 12 quarters represent sustained judgment, not reaction to a single variable. Interest rates moved. Inflation fluctuated. Markets corrected and recovered. Yet net selling persisted. If markets were temporarily mispriced, opportunistic buying would appear. Instead, liquidity deepened. This suggests the issue is not cyclical volatility. It is structural valuation. Consider the relationship between interest rates and equity valuations. For over a decade, suppressed rates justified higher multiples through discounted cash flow models. When rates rise, discount rates increase, theoretically compressing valuations. Yet markets adjusted slowly. Earnings resilience and AI narratives filled the valuation gap. But structural deficits now require sustained Treasury issuance. That issuance must be absorbed by domestic institutions, foreign buyers, or the Federal Reserve. Higher supply of sovereign debt exerts upward pressure on yields unless demand remains strong. Higher yields compete with equities. Short-duration treasuries, yielding meaningful returns, reduce the opportunity cost of holding cash. In prior decades, cash yielded near zero. Today, it yields enough to wait. This is critical. Cash is no longer purely defensive. It is strategically patient. Buffett may not be betting against equities. He may be betting on optionality in a tightening liquidity architecture. And that is abnormal in an era still defined publicly as expansionary. Strategic interpretation surface explanation. Valuations are high. Strategic interpretation. Asymmetry has inverted. Buffett's philosophy centers on margin of safety, the gap between intrinsic value and market price. When that gap narrows, expected returns compress while downside risk expands. But there is another layer. Berkshire is deeply intertwined with the U.S. economic architecture. Railroads, utilities, insurance, consumer goods, industrial manufacturing. It has visibility into freight volumes, energy consumption, pricing power, insurance claims, supply chain disruptions, and consumer spending patterns. These are not abstract data points. They are real-time economic sensors. If internal data suggests slowing demand, rising input costs, deteriorating underwriting conditions, or margin compression, equity valuations based on forward optimism become fragile. Strategic allocators respond before headlines confirm trends. Additionally, insurance float imposes discipline. Large-scale catastrophic events, climate-related volatility, geopolitical instability, and supply chain disruptions all affect underwriting risk. When macro uncertainty rises, preserving liquidity strengthens institutional resilience. There is also political dimension without theatrics. U.S. fiscal expansion has reached peacetime records. Debt servicing costs rise as rates normalize. Political polarization complicates fiscal restraint. Global de-dollarization discussions, while often overstated, reflect shifting reserve dynamics among emerging economies. None of these individually predict collapse. Together, they represent friction. Buffett's move can be interpreted as preparing for repricing of risk, not economic apocalypse, but valuation recalibration. When markets are priced for seamless continuation, even modest friction can compress multiples. And when multiples compress, liquidity becomes power. Who is absorbing the pressure? If Berkshire is stepping back, others must be stepping forward. Passive index funds continue absorbing retail and institutional flows. Their mandate requires allocation regardless of valuation. This creates price-insensitive demand. Retail investors, empowered by technology and narratives, chase growth sectors. Corporate buybacks, though slowing in some sectors, remain a stabilizing force for equity prices. Foreign capital still participates in U.S. markets due to relative stability compared to alternatives. In effect, valuation risk is being absorbed by entities less sensitive to margin of safety discipline. Passive flows do not analyze intrinsic value in the traditional sense. They replicate indices. This can amplify momentum on the upside and accelerate decline if flows reverse. Additionally, pension funds and retirement accounts, facing actuarial return assumptions, require equity exposure to meet long-term liabilities. They cannot easily pivot to 100% cash. Buffett can. That asymmetry matters. He operates without quarterly performance pressure, without redemption risk, without index tracking mandates. Therefore, his liquidity choice is unconstrained. Others are constrained, and constrained actors often absorb risk longer than fundamentals justify. Where the money is actually going, it is tempting to frame this as capital exiting risk entirely. It is not. It is repositioning into sovereign short-duration instruments. This strengthens demand for U.S. Treasuries at the short end of the curve. At scale, this supports government financing needs while preserving capital mobility. Short-duration positioning minimizes duration risk, exposure to interest rate volatility, while maintaining yield. This suggests uncertainty around rate trajectory. If rates fall sharply due to slowdown, long-duration bonds would outperform. Buffett is not positioning aggressively there. If rates remain elevated due to persistent deficits, short duration protects against mark-to-market losses. This is not directional speculation. It is flexibility engineering. The money is not hiding. It is waiting. And waiting capital influences future cycles. When distress appears, whether through credit markets, private equity repricing, commercial real estate stress, or equity correction, liquidity holders dictate terms. In 2008, Buffett negotiated preferred shares with high yields and warrants attached. He did not buy broad indices. He structured asymmetric deals. Liquidity transforms into leverage when others need it. Thus, current positioning may reflect anticipation of forced sellers elsewhere in the system. Commercial real estate faces refinancing at higher rates. Private equity valuations remain under pressure as exit markets tighten. Regional banks confront balance sheet stress tied to long-duration securities and real estate exposure. These pressures are not collapsing headlines. They are slow compressions. Capital positioned in cash benefits from slow compression. Why this weakens one side and strengthens the other. High valuation environments benefit momentum participants. They weaken disciplined allocators who refuse to chase. But when valuation reverts, the opposite occurs. Buffett's move strengthens Berkshire's negotiating power in future downturns. It weakens entities dependent on continuous liquidity expansion. If equity markets stagnate or decline modestly over multi-year horizons, not crash, but underperform inflation-adjusted expectations, passive retirement investors absorb real return compression. Meanwhile, cash deployed at lower valuations later produces higher long-term returns. This is cycle transfer, not destruction. Transfer. Additionally, sustained federal deficits require Treasury absorption. Large buyers stabilizing short-term issuance support fiscal continuity. But if confidence in long-term fiscal trajectory weakens, long-duration bonds become volatile. Short-duration liquidity avoids that exposure. In geopolitical context, rising global fragmentation introduces supply chain redundancies, higher defense spending, and commodity volatility. These increase structural costs. Higher structural costs pressure margins. Pressure margins reduce earnings growth. Reduced earnings growth challenges high multiples. The system does not fail overnight. It recalibrates. Buffett's pivot suggests recalibration awareness, not collapse expectation. Awareness. When the most patient allocator in modern financial history prefers optionality over participation during record optimism, it signals perceived asymmetry. He is not declaring crisis. He is declining complacency. And that distinction may define the coming cycle. The ignored signal is not dramatic. It is quiet. Cash is not loud, but it is heavy. And when nearly $400 billion shifts into waiting position, the weight alters future gravity. The market narrative remains confident. The capital narrative has turned cautious. Between those two lies the next phase. There are moments in financial history that are loud, and there are moments that are decisive. They are not the same. The loud moments come later, when markets break, when headlines accelerate, when volatility demands explanation. The decisive moments happen earlier, quietly, behind balance sheets, inside allocation decisions. We are not observing panic. We are observing repositioning. And repositioning, when executed by actors with long-duration capital and generational memory, carries more informational weight than commentary ever will. This moment is fundamentally different from prior cycles for one reason. The global system is no longer expanding under the same assumptions that built it. For decades, markets operated on three pillars: falling interest rates, expanding globalization, manageable sovereign debt growth. Those pillars provided structural tailwinds. Asset prices inflated not only because productivity increased, but because discount rates fell, supply chains optimized for cost, and fiscal expansion remained credible. Those conditions are no longer intact. Interest rates are no longer structurally declining. They are structurally constrained. Globalization has shifted from efficiency to resilience. Resilience costs more. Sovereign debt has grown to levels that require continuous refinancing at non-zero rates. The architecture has changed. The facade remains polished, but the load-bearing beams are under different pressure. In prior cycles, safety meant equities over time, bonds during recession, cash only temporarily. Today, safety is conditional. Conditional on fiscal credibility. Conditional on central bank independence. Conditional on geopolitical containment. Conditional on continued liquidity absorption. Safety is no longer static. It floats. That is the structural shift. When Buffett accumulates short-duration sovereign instruments rather than productive assets, he is not declaring those assets obsolete. He is acknowledging conditionality. The old rule, cash is trash, was built during an era of zero-yield liquidity and predictable stimulus responses. But when cash yields meaningfully and asset valuations reflect perfection, optionality regains strategic relevance. Optionality is not fear. It is positioning under uncertainty. Systems do not fail violently at first. They fail quietly. Margins compress. Credit spreads widen subtly. Liquidity becomes selective rather than universal. Bid-ask spreads expand. Deal velocity slows. The visible system continues operating. The invisible system tightens. These are not collapse signals. They are compression signals. And compression alters behavior before it alters headlines. Traditional safe havens may not function the same way in the next phase. Long-duration bonds carry duration risk in a high-debt environment. Equities carry valuation risk in a high-multiple environment. Real estate carries refinancing risk in a higher-rate regime. Commodities carry geopolitical risk in a fragmented trade system. Cash carries inflation risk, but also agility. The hierarchy of safety is rotating, not disappearing. Rotating. Watch the behavior of insiders, not the commentary of optimists. When share buybacks slow at peak valuations, that is signal. When equity issuance increases quietly, that is signal. When private equity extends fund life cycles because exit markets are constrained, that is signal. When banks tighten lending standards incrementally rather than abruptly, that is signal. The next phase will not begin with a crash. It will begin with persistence. Persistent underperformance relative to expectation. Persistent earnings misses in overvalued sectors. Persistent demand for short-duration sovereign paper. Persistent difficulty refinancing marginal credit. Persistence reshapes confidence. Confidence reshapes pricing. Pricing reshapes balance sheets. And balance sheets determine survival. Buffett's pivot is not about predicting timing. It is about acknowledging structure. He is positioning Berkshire not for excitement, but for leverage when leverage becomes scarce. Scarcity defines the next cycle. Scarcity of cheap capital. Scarcity of flawless earnings growth. Scarcity of policy flexibility. When scarcity enters a system built on abundance assumptions, repricing follows. Slowly at first, then structurally. This is why the moment matters. Not because a 95-year-old investor stepped down, but because he chose to leave behind insulation rather than expansion. That decision implies expectation of volatility in opportunity, not certainty of collapse. There is a difference. Volatility creates forced sellers. Forced sellers create mispricing. Mispricing creates asymmetric entry. Liquidity converts into control. This is cycle law. The public narrative remains confident in technological acceleration, and technological progress is real. But markets price narratives at extremes long before outcomes are measurable. The more crowded the optimism, the thinner the margin of safety. What must be watched going forward? Not headlines. Not daily index moves. Watch Treasury issuance absorption rates, corporate refinancing spreads, insurance underwriting profitability, freight volume trends, bank lending standards, private equity exit velocity, share buyback consistency, foreign participation in sovereign auctions. These are structural indicators. If they deteriorate quietly while indices remain elevated, divergence widens. Divergence resolves eventually. It always does. Current stability is not illusion, but it is conditional. It depends on continuous liquidity, recycling, sustained earnings growth, and political capacity to manage deficits without eroding confidence. Remove one pillar, pressure increases. Remove two, repricing accelerates. Remove three, structural reset emerges. Buffett's move suggests awareness of pillar fragility, not collapse, fragility, and fragility in complex systems compounds under stress. The next phase may not resemble 2008. It may not resemble 2020. It may resemble prolonged valuation compression similar to the 1970s or early 2000s, periods where returns stagnated while volatility persisted. Such environments do not destroy markets. They exhaust participants. Exhaustion leads to capitulation. Capitulation creates entry. This is not a forecast. It is cycle geometry. Old models assumed ever lower discount rates. Old strategies assumed globalization efficiency. Old risk metrics assumed central bank immediacy. Those assumptions are weakening. New assumptions are forming, but they are not yet visible in full. That is why this pivot matters now. Before outcome, before stress manifests, before narrative shifts. Because capital has already adjusted. When capital adjusts before commentary, structural change is underway. This document does not predict collapse. It records positioning. And positioning at this scale reflects probability assessment beyond public discourse. Years from now, analysts may search for the moment the cycle turned. They may look at geopolitical events, earnings recessions, policy mistakes. But structural turns rarely announce themselves through spectacle. They begin when disciplined actors reduce exposure to exuberance. They begin when liquidity is valued more than participation. They begin quietly, behind the scenes, hidden in allocation tables rather than headlines. Warren Buffett's historic pivot at 95 is not dramatic. It is deliberate. It does not shout. It reallocates. And in systems governed by capital flows, reallocation is destiny. The architecture has shifted. Gravity is reasserting. And the weight is already moving. Record this accordingly.